Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today, I think this is going to be a fun one. We're going to be going through a beginner's guide to the power and peril of trading options. It's going to be a pro and con approach where we're going to be looking at an example option strategy, weighing three potential powers or advantages that might be delivered by that strategy, and three big risks that we need to bear in mind. So there's a lot to cover. I'm going to go at a pace that hopefully everybody can follow. But before we get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see some familiar names out there in YouTube land. Also great to see a lot of new names. So hello there, Olga and Janelle. Marquise, we have Sam and Herman, Life in the Fast Lane. Mariana, Will, did I already say Will? Gary, Alice, everybody else, Eva, great to see everybody. So hello to all you returning veterans. Great to have you back. If you are among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. That's a great way to watch these webcasts. But you're certainly invited to join us here in the live stream audience. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let you know that my very good friend Kevin Horner is hanging out in YouTube chat. He's going to be keeping an eye on any questions that come in, and if I can't get to those just during the flow of the presentation, Kevin's there to help pick up the slack for me. We have a lot of people watching the live stream. Looks like several hundred already. So Kevin, you're going to be busy, but thanks for being there. Now, Kevin and I would also like to issue an invitation to everybody watching, whether live or on the archive, to follow your favorite Schwab presenters on social media. You can find us on X, you can find us on LinkedIn, so you can pop over to X and find Kevin there at Kevin Horner CS. You can find me on X at Cameron May CS. You can also find me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS will take you right to my profile. Give me a follow there. And when you reply to my posts on social media, I just try to reply right back to you. Great place to connect with me in between the live streams. But let's get into this discussion. It's a good one, but before we can do this, of course, we need to acknowledge the risks, the perils of trading, and that includes options. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your own trading account is solely your responsibility. All right, so let's set the agenda for today's discussion. So as I mentioned, this is a beginner's guide to the power and peril of trading options. So what we're going to do is we're going to look at a quick chart to set up sort of an option trade scenario. And today we're going to be trading a long call option. Not everybody's going to know what that is, so I'll explain what it is. And then we're going to do a side-by-side comparison. What attracts some traders to buying long calls? And what risks might they want to keep in mind as they're doing so? So three powers, three pros of the long call strategy, but also three perils or three risks. And then before we're done, just so that everybody can see how to connect application to the theory that we've discussed, we're going to go ahead and place an example trade. All of this is going to be done on what's known as the Thinkorswim paper money trading platform. So if you're not familiar with Thinkorswim, let's start there. Let me show you the software that I'm going to be using today. So this is what it looks like. This is the Thinkorswim simulated trading environment. I'm going to pop over here to a chart of Visa, which is going to be our example stock today. But some of you are not familiar with Thinkorswim. So this is trading software that can be downloaded free of charge from within your Schwab Online account. So to get Thinkorswim, you just pop into your account. So here's just an example account. Go to the Trade tab right here, and then look for Thinkorswim Desktop. So that's what I'm using. We'll click on Thinkorswim Desktop, and if you scroll down just a little bit, there's a big blue button right there. It says Learn how to enable Thinkorswim. That'll explain what Thinkorswim is. It'll help you download it, and then you just log in to Thinkorswim using your Schwab login credentials. Same username, same password. All right? So let's go to Thinkorswim, and let's get into this topic for today, the power and peril of trading options. Yep, we're gonna be trading an option today. So let's put ourselves in the shoes of just a theoretical, it's a hypothetical option trader out there. Maybe they've been keeping an eye on Visa. So the trading symbol here is V. We're on the Thinkorswim charts tab. And maybe what they've done, now I've drawn a series of lines and numbers. If you're wondering how those were generated, I just drew them on there using the drawing tools that are available right down here. But let's say that our trader has noted that Visa has been on a pretty good climb here. So going back to April, which is when a lot of stocks bottomed out, we've been seeing a pretty sharp increase in price. And Visa's been doing that in sort of a stair-stepping pattern, running up and pulling back and running up and pulling back and running up and pulling back. So here we saw a run up of about $25. Now I've done some rounding for convenience purposes, but then it pulled back, up 35, pulled back, up 20, pulled back, up 35, pulled back, up about 40. And then we pulled back again, and let's say that our trader now suspects, boy, it looks like over periods of maybe a few days to maybe a few weeks, this is now going back over the last several months, we've seen these nice run or increases in stock price. And let's just say this is their hypothetical outlook for the stock. Stock has gone through another cyclical run up. Maybe they think it's fallen back far enough, and I think it might start to rise again here. And kind of sticking with recent history as a guide, there's no guarantee that history will repeat itself, of course. But maybe they're thinking, you know, if my timing's okay, maybe Visa will go up another 25 bucks, like it has several times in just the last few months. Now, for a stock investor, that might be looking like a 6 or 7% increase, but they, our hypothetical trader here, are attracted to the power of options. So rather than buying the stock, we're going to go get ourselves into an option contract. So I'll tell you the contract details here. Anybody that tells me, hey, Cameron, sign this contract, my hackles go up, my ears perk up, and I start thinking, what's the deal that I'm getting myself into here? Contract is a very serious deal. So Maria says, good question. Why Thinkorswim desktop versus a web version? So I am using desktop. It is the most robust version. Web is kind of a stripped down version for access and convenience purposes, but some people prefer it that way. So that's it. It's sort of, some people prefer the more robust desktop, but there's a lot to it. So there's more to learn. Some prefer just the basics, pop over to web. Anyway, but yes, there are 3 different versions. There's a desktop, there's web, which is just access through your browser, and there's also an app called Thinkorswim Mobile. But let's get ourselves into a contract, an option contract. This is kind of where it gets a little bit nervous, doesn't it? Especially for those that are here for the very first time. Maybe this is your first exposure to trading options. How many people do we have watching right now? About 550 people watching live stream right now. I would suspect that there are hundreds who have just never traded options before. That's why they're here. So let's go do it. I'm going to go to the Trade tab here on the platform. And if we make sure that we type in our symbol up here in the symbol box, we can see quote information for trading the stock right across the top, but down below is something known as the option chain. What this option chain, the way that I see this is kind of an advertising bulletin board for getting into different contracts related to the stock, but we're using options here. So notice there are some associated dates, there are some numbers in parentheses, and then there's this number 100, okay? The dates tell us the length of each of these contracts that we might get into. So we can get into 3-day contracts that expire on the 10th of July. They only run for a few days. That's what this date is. Right now it's the 7th of July. So yeah, 10th of July is 3 days away. So that's pretty easy to read. That's the 26th is for 2026. Now we could also get into contracts as far out as, if you'll notice the further down the chain we go, the longer the contracts get, we can get into a contract for as long as the 15th of December of 2028, which is 892 days. Now, importantly, regardless of which one we choose, you'll notice this number 100. These contracts are for the potential exchange of 100 shares of stock. That's what that means. So how about we just say, maybe our trader here is looking at, okay, the stock might go up for 2 or 3 weeks. And maybe they're expecting it to maybe go up $25 from where it is right now. Could buy the stock. 100 shares would cost us about $35,000. Or What if we got ourselves into a contract lasting at least a few weeks to make sure that it covers the time frame that we think it might take for the stock to go up? I'm going to go here to the 21st of August. Those are 45-day contracts. That's going to give us not just a few weeks. Instead of giving us 3, it gives us 6, about twice as long as we might need. That's one rule of thumb that some traders might use in choosing an option contract. Well, let me click on, if you'll notice there's a little arrow or carrot looking icon just to the left of the date here. If I click on that, it reveals all of this information. Okay? Now, each one of these lines, if we look at the left hemisphere here, this left side, each one of these lines represents information about a specific call option contract. And I want to draw your attention to this middle column first. Notice it's titled Strike. What we're going to do here is we're going to strike a deal where we're going to pay another option trader somewhere out there in the option trading universe. We're going to pay them a certain amount per share to get into a contract with them. And it's going to be a fairly straightforward contract. We're paying them in exchange for the right to buy shares of stock from them. That's what a call option is. So how about, I'm going to go down this strike column, and with the stock trading right now about 350 bucks, I'm going to look at this strike that says 350. And we're going to strike a deal to get into a contract where we're going to have the right through the 21st of August for the next 45 days to buy 100 shares of Visa from someone else for $350. That's at any time for the next 45 days, right? So if I look over to the left here again, I'll notice 2 columns. Pay attention to these 2 columns, bid and ask. These are basically the price of this sort of a contract at the moment. And you'll notice at that 350 level, that price is between $13.45 per share and $13.90 per share. What I'm going to do is kind of split the difference. Let's say Real Kick Block says, I missed a few minutes. Can I get the recording? Yes, that will be posted shortly after this webcast is concluded, assuming we don't have any technical hiccups. Should be on our YouTube channel pretty quickly. As a matter of fact, let me pause the presentation for just a moment because I know a lot of you don't know how to do this, but yes, you can either watch our webcasts live or you can watch them on our YouTube channel after the fact. So do yourselves a favor. If you haven't done this already, make sure you're subscribed to our Trader Talks channel on YouTube. The full title is Trader Talks Schwab Coaching Webcasts. And you can subscribe by popping down below the video stream right now. Just click on the subscribe button for YouTube. Doesn't cost anything to do that. But this is where where you can join our live streams, but you can also find the playlists for previous webcasts. And as one of these playlists, a couple actually, that I have a strong suggestion that you visit. Number one is if you're brand new to options trading, I set up a series of video lessons, just starting with the basics, going in what I call building blocks to learn about what options are, how we can do actually fancy options trades with different combinations of options, how options are priced, how they make money, how they lose money, all of that stuff. So you'd go to playlists and you'll notice just a few rows down, we have a lot of playlists, but there's one that says, start here to learn about trading options. It has my face right there on it. So you just click on view full playlist and this will have those 10 lessons. So you can work your way through those. Let me quickly, how about I'm going to put a chat in for those that are watching the live stream right now. I'll put a link in directly to that playlist. There you go. All right. And then for those that are watching on the archive, I'll also link the playlist down in my video description. Anyway, there we go. So welcome. Yes, you can watch these after the fact, but let's go back to the platform. And I want to get let's get into one of these contracts. So here's how we do it. We're going to go to the strike price. We're striking a deal to maybe buy shares for $350. We're paying someone somewhere between $13.65 and $13.90 per share. To enter this order, I'm going to click on the price under the ask. It's kind of like, if I were talking to this individual in person, I'd say, hey, you know what? I want to get into a contract with you. Here's the deal. I just want, for the next 45 days, the right to buy 100 shares of Visa from you for $350. How much would you ask me for that? And then you pay the ask price. So I'm going to click on the ask price there. And that creates an order to buy one of these contracts in my example account. Now, in yours, it might say 10. So that would be 10 contracts to buy 100 shares. Or in other words, that'd be the right to buy 1,000 shares. I'm just going to make sure this is for one contract. So we're buying one contract, 21st of August, $350 call. And that price is right around $13.90 right now. I'm just going to leave it right at $13.90. Let's leave that as our limit. A limit just means that's the most I'm willing to pay to get into this deal. And let's click confirm and send. So I'm buying this one contract, 21st of August, 350 call. And you're like, Cameron, I don't even know what you're talking about right now. I don't understand these contracts yet. That's okay. Sometimes it's kind of nice to get the heart moving a little bit and then hit the pause button and figure out what did we just get ourselves into. Maria, you like this? Okay. One thing I need to point out, though, is that there is a commission associated with this trade. It's 65 cents. It's not 65 cents per share. It's just 65 cents. So instead of it costing us maybe $1,390 to do this trade, it might be $1,390.65. But that $13.90 is basically we're saying we're willing to spend $13.90 per share for the right to buy 100 shares. So it's $13.90 times 100. Okay. But let's send that order off. Let's see if we can get that filled. And we did. Bought that for $13.60. You'll notice that right up here. Bought that call for $13.60. So here's what we just did. All right. This is our example trade. We bought a call option, also known as a call contract. So specifically, we bought the 21st of August 350 call for $3.60 per share. Or another way that we could describe that, setting the commissions aside, that was a $360 trade. All right, $360 investment we just made. So I want to talk about, first of all, why is it called a call? Why is it called a contract? All the basics like that. What are the pros or the potential power that we've accomplished by doing this? But also, what are the risks? What are the perils we've gotten ourselves into? All right, so let's talk about just the basic elements of the contract. As we mentioned, we're paying a certain amount. I said 13, didn't I? Boy, I botched that. That's why I always double check my numbers. It wasn't 360 per share. It was 1360 per share, or $1,300 trade. You saw that on the trade confirmation page. So that's what that is. All right. But basically, we are getting ourselves into a contract with another trader out there. Now, it's not, don't worry about who's on the other end of this trade. That gets a little bit fuzzy. It doesn't really matter. But basically, we now have the right to buy 100 shares of Visa at any time for the next 45 days or through the 21st of August. We have the right to buy those shares for $350. Now, in the old days, we would have done this sort of a transaction over the phone. You know, if anybody goes back that far, I certainly do. But in the old days, we would have done this over the phone. And if we were in this contract and we decided sometime in the next 45 days, you know what? I think I will buy those shares. I'm going to call for those shares. Make a phone call. Call, say, hey, I want those shares. Yeah, there we go. So it's a call option. You notice it's referred to as an option. It's because we're not paying $13.60 per share or $1,360 overall to give ourselves an obligation. No, we have the option now to buy 100 shares of stock at any time for the next 45 days. So that's powerful. That's interesting. So let's look at the very first power that comes from doing this sort of a trade. You may have already detected it. And that is, we have a fraction of the cost to do this trade versus buying the stock. So if we compare this to buying the stock outright, let's say we have trader A and trader B. Both of them see the same scenario. Trader A sees the stock, maybe it's about to go up 25 bucks, so they buy the stock. Well, at $350 per share, that's a $35,000 investment. Trader B doesn't buy the stock. Instead, they choose to buy the stock's option, or in other words, a call. And so instead of spending 350 bucks per share, they spend $13.60 per share. Now, they don't own the shares, but they own the right to own the shares. This is a contract. So we now have, for the next 45 days, a contractual guarantee, a right that we can buy the shares for the same 350 bucks, but not just today, but tomorrow, the next day, the next week, even next month, regardless of how much those shares are worth. So we sort of, now some people will say we have control of the stock. That's kind of a false narrative. We don't have control over the stock. A shareholder doesn't have control over the stock. The stock's going to do what it's going to do. But what we do have is a contractual right to buy shares for a prescribed price for a prescribed period of time. And that carries a ton of power because this now carries leverage. Sam says, and you can sell the option at any time, assuming good liquidity, because there are some options out there where hardly anybody trades them. It's hard to get into them. It's hard to get out of them. Visa tends not to be one of those kinds of stocks because it's one of the biggest companies in the world. Lots of people trading its options. Still not a guarantee that we can get in and get out extremely fluidly at any time, but it tends to be easier than, with, let's say, some less heavily traded stocks. So it's not a sales pitch for Visa, but for some options traders, the size of the company is a big consideration for liquidity purposes, getting into and out of these sorts of contracts. But let's explore the leverage of this. Let's look at Trader A. They buy the shares for 350 bucks, and then let's say it does go up $25 up to 375, and they sell. Well, they just made 25 bucks on a $350 investment. My rough math says 6 or 7% return. Okay. Well, what about Trader B? They have the right to buy the shares for the same 350. If it goes up to 375, now they could, at that point, exercise their right to buy the shares, and they're making a $25 profit on the stock that they only paid $13.60 for. That's roughly a doubling. Not a 6 or 7% return, but that's pretty close. I'm doing some generous rounding here, but that's about doubling the investment on the same move on the stock. Can you say leverage? That's leverage. Yeah. Vince says, can you explain the Greeks and how the value of the contract decays over time? Vince, I definitely can, and I actually definitely have. Let me make a suggestion for you. Another reason why you want to make sure that you're subscribed to our channel. Go back to our channel here, and let's just type in, I'm going to do a keyword search here on the channel. So I've gone to Trader Talk Schwab Coaching Webcasts on YouTube. I'm going to type in Greeks and hit enter on my keyboard. What do you know? Option Greeks for beginners, Delta, Gamma, Theta, Vega, and even this little one called Rho. Yeah, there you go, Vince. You might want to check that one out. But you know what? Vince, let me do you a little solid here, Vince. Let's go back here and look at leverage in a different way. So yes, this call option, if we buy it for $13.60 right now, if the stock goes up to $3.70, maybe we map this out. Here are the powers, potential powers. Ooh, I'm going to make that all caps just so it kind of stands out. No, come on, let's try that again. There we go. Power number one is leverage. Okay, buy the stock for $3.50, for sell it for $3.75, 6-7% return. Buy the option for $13.60, exercise it. If it goes up to $3.75, now we're buying the stock for $25 less than it's worth. Hey, that's a $25 value delivered at a $13.60 cost. That's a close to doubling of our investment. It actually needed to get up to $27.20 to actually double, but close enough, right? But that does illustrate the leverage. Now, another way is to use something that Vince just suggested. It's called the Greeks. Let me show you one of the Greeks. All right, I don't want to get too fancy with this, but what you'll notice here, next to our 350 strike price on our option chain, is something called Delta. Delta starts with D, So does dollar. What this helps us do is gauge how much we might make or lose on our contract if the stock goes up $1. All right, we're thinking it's going to go up 25, but let's just talk about $1. Now, actually, there's another thing that Delta might do. It also gives us the rough probability that this contract, if we let it go the full length, all 45 days, there's about a 54% chance that it retains some value at expiration. That's one way to interpret this. But another use for Delta is to gauge, hey, if the stock starts to move in my direction, how much money am I making? So Delta starts with D, so does dollar. Let's say we buy this contract for $13.60 right now, and then the stock goes up $1 right away. Pop. It's not even 45 days from now. The stock goes up $1. Well, this delta of 54 tells us we've probably just had an unrealized gain of 54 cents on that investment. So our 1360 option, after a $1 move up, makes that call more valuable. And specifically, it makes it 54 cents more valuable. So assuming that happens quickly and there aren't other variables changing things, this would be about a $14.14 contract. So that's one of the Greeks. It tells us how much our contract benefits if the stock goes up. And you think, wow, 54 cents, actually, that's not too bad. That's already, what, about 4% increase in the value of our option on a $1 move on a $350 stock. That's about a 1/3% move on this, 1/3 of 1% move. It's a tiny little move on a $350 stock, producing a 4% unrealized gain. That's a good example of leverage. So, oh yeah, a lot of people attracted to buying options due to the leverage. However, that's the fun part. Now we've got to balance it. It's not fair if you have an educator who's only teaching you the fun side of the equation. What are the perils? Well, our first peril is that leverage can work against the trader, right? If a stock can go up $1, which Visa certainly can, it can also go down $1. Just because we've noted a little bit of a pattern here in the way the stock has been moving, does that mean that's going to be the pattern into the future? Nope. Now, what if the stock sags down? Well, if it goes down $1, we might lose that 54 cents. If it goes down more, we might lose more. And we can lose it quickly. Yep. The leverage can really ramp up the potential for reward. It can turn a 6 or 7% move on a stock into possibly an 80, 90% profit on an option, but it also can turn this thing into a loss. So be aware that leverage can work in both directions, and it's not fair to the trader if they're trying to prepare themselves with a balanced view of how options actually work to just focus on the reward potential. This is what the trader is hoping happens, but this is something that they have to also plan for. All right, so leverage, it's the power, it's also a peril. Let's look at power number 2, and that is there is a limited risk in what we're doing. Okay, Steffi says, do you have a video for beginners about trades and stocks and investments? Absolutely, Steffi. Yeah, what you want to do is go to our YouTube channel. I've shown you a little bit earlier in the webcast a couple of times. I'll do it again at the end, but just look down through our video series and you'll see a lot of our videos are oriented toward trading, which is kind of shorter term. A lot of our videos are more oriented toward investing. So for example, I teach a video series on Thursday mornings. It's called Investing in Dividend Stocks. I don't do any trading. I make investments, example investments in that, and we build out a portfolio. And just an example portfolio, very rare changes are made. Yep, that one's for the longer term. All right, but next up, our second of our 3 powers of trading options is the limited risk of what we're doing here. Let's get real again about stock investing. If I buy the stock for 350 bucks and then I put my head in the sand and just let her rip, how much risk do I have in that investment or that trade, however I view it, short-term, long-term, whatever? Well, whatever we've invested is how much we have at risk. If we invest 350 bucks in a stock and that stock goes to zero, and I know you think it's not going to, and I'll be fair, is Visa going to zero tomorrow? Probably not. Is it going to zero next month or next year? I can say with a high degree of certainty, probably not, but it still could. And if it does, the shareholders that hang on can lose their full investment. Well, when we buy a call option, we can also lose that investment. It's just smaller. So hey, 350 bucks invested, 350 bucks at risk. That's $35,000 at risk. In this case, $13.60 invested, or in other words, $1,360 at risk. With when we're buying options, what we say is there's a theoretical maximum risk. Theoretical sounds like an awful squishy term though, right? It is, yeah. But there's a reason we say theoretical, because there are things that can come in and change the risk. If we, for example, choose to exercise our right to buy the shares, now we've changed the structure of our trade. Now we own shares, and now we have new risk, right? But if this trade doesn't work out, we could lose, in a worst case theoretical scenario, $1,360. And so for some traders, they're attracted to that. I'm only tying up $1,360 in my portfolio instead of $35,000. I'm only risking $1,360 in my portfolio instead of $35,000. Common question for me is, and I would guess, how many people do we have watching now? Probably close to 700. Yeah, well over 600. Yep. Some of you are probably saying, Cameron, one thing I don't understand about options. So if I buy a call, am I also required to own the stock at the same time? No, no. This is a contract to maybe buy the stock later. No, there's no requirement that we actually own shares, right? So this is how much we have tied up in this investment. Yes, plus that 65-cent commission, $1,360 at risk. So limited risk, great. That can be attractive to some traders who are trying to take much smaller positions on anticipated move in the stock, but that also is delivering that leverage punch. Well, here's a potential issue with that. There's also associated with that risk, high probability it'll happen. I'm going to say there's a high probability that we lose 100%. That's the reality of buying contracts. Let me do a little hypothetical here. All right. Stocks trading right now pretty close to 350, a little bit below. You'll notice it was over 350 at the time we started talking. It's a few pennies below 350. Let's just say instead of going up, it just does this. Let's say it just goes sideways. And there's our August expiration. It's that red dashed line over here. See that 8/21/26? Let's say that our stock is at 349.99. It's just a shade below 350 bucks. And let's compare that to stock ownership, right? Well, if we bought the shares on day one for 350, and then they go dead sideways, or maybe they're just going up and down, just waffling around, and we wind up at 350 45 days from now, it's kind of a waste of time. It's kind of boring, but is it painful for our stock investor? Not really. They paid 350, it's still worth 350, there's no loss. However, what about for our option trader? They spent $1,360 to lock in the right to buy shares for 350, and now we get to the end of the line, and the shares, let's say they're worth 349.99, just a penny below. Well, now we have the right to overpay for the stock, and there's no time left for it to gain any additional value. That contract, congratulations, is now worth less. Not worth less, but it's worthless. So we've lost the full investment on the stock, not even doing anything painful. It just went sideways. It can accelerate that loss if it goes down. Now, what it can't do is magnify that loss. The 1360 is the most that can theoretically be lost here in this trade. But there's a high probability that could happen. How high? Well, in this example, it's about 50-50. Now, when you put that in contrast against stock ownership, what are the odds that our stock investor who paid the $35,000 up front also loses their full investment? It's almost zero, because the stock wouldn't just have to go sideways. To lose a full investment in stock shares, it'd have to go down to zero. There's just not a strong likelihood that Visa is going to do that in the next 45 days. But there we go. Couple of potential powers, lots of leverage, limited risk, but that leverage can work in the opposite direction. And hey, the risk is limited, but it's higher probability than stock ownership. That's a realistic view of what we're getting ourselves into. One more thing that I wanted to talk about that can be very attractive to investors in options contracts is there is unlimited potential in these trades. That does not separate it from share ownership. If we buy the shares at $350, again, trader A versus trader B, let's say trader A spends the $35,000, they buy 100 shares of the stock, and then the stock starts to go up. Well, they're making money. And the higher the stock goes, the more money they make as long as they are a shareholder. That's the way, that's one of the attractive things for some investors for share ownership. Well, the same thing applies to an option contract. If the stock starts to go up and we've already locked in a purchase price of $350, the higher that goes, the more money we can make. Just because we thought it might go up to $25 doesn't mean it's going to stop at 25. What if it goes up $50? What if it goes, let's exaggerate things a little bit, but not entirely exaggerated. What if some really good news comes out on Visa and Visa pops from $350 to $450? Hey, we still have the right to buy shares for $350. We only paid $13.60 for that, and now that right is worth at least $100 per share. We're looking at maybe 8 times, an 800% increase in the value of our contract for the stock going up, what, 30%? That's that leverage coming in. There's unlimited reward potential. So that sounds really good. But what's the peril? There is limited time to realize any potential reward. With a stock, if we own the stock, there's no time limit. We own the stock. We can sit around a day, a week, a month, a year. And as long as the stock decides to go higher at some point, we're in good position. With an option trader, there's a reason we call it trading. It's a short term, at least in this example. The clock is ticking. And every day that goes by, we have fewer days to realize any portion of that unlimited upside potential. So we have 45 days in this example. Now, every day that goes by actually has a negative impact on this contract, because when we're buying it here on day 1, there are 45 days of potential. Day 2, there's only 44 days of potential. Day 3, there's only 43 days of potential. Every day that goes by, there's something known as time decay that can chip away at the value of our contract. And so there's sort of a teeter-totter effect. The stock needs to go up fast enough and far enough to compensate for that loss of value in the contract. So here's an example. If we pay $13.60, and let's say the stock only goes up $10, let's say it goes up here to $3.60 and we hit our expiration. Well, we have the right to buy shares for $3.50. Those shares are worth $3.60. Great. It's worth $10. But there's no time left for it to gain any more additional value. So if we exercise that contract at expiration, we retrieve $10 of value out of something that we paid $13.60 for, and we actually lost money. So the stock went in the right direction, but it didn't go far enough to compensate us for the cost. So that limited time can certainly play a role. Even if it's on the way, it just ran out of time. So there are pros and there are cons. There are powers and there are perils to trading options. What I'd like you to do, this is not an exhaustive list. I think it's a pretty good introduction. But maybe if you're watching on the YouTube archive, if you're just watching the recording, pop down in the comments, leave a comment. What are some of the other advantages of trading options that you're aware of? What are maybe some risks that you're aware of. So if you leave comments on my videos, I'll also go in and reply to those comments. Anyway, but we've placed our trade. Somebody asked me to show how to place the trade again. Yep, what we do is go to the trade tab, make sure that we've typed in our symbol up here, and then we go down here to the option chain. Okay, there's a scroll bar here that lets us move up and down that option chain. We can choose the time frame of the contract that we're getting into. So let's just say we went to the 21st of August, click on this little caret, and that exposes some options that are available. And then we choose what we call a strike price, the price at which we're going to strike a deal to maybe buy the shares from somebody else. We chose $3.50, just kind of for convenience purposes, because that's about where the stock is. Now we could have said, hey, I want to buy the shares at a lower price, $340. If I want to do that, I can get into that kind of a contract. It's just going to cost more. We're asking someone to sell us their shares at a lower price than those shares are currently worth. So you have to pay them more for that. Or we could have said, we're willing to pay a higher price. We're just not willing to pay as much on a per share basis for that right. And then to place the order, we just click on the ask price, and that creates a buy order down here. We just customize the quantity. We can set what we call a limit order if we want to control the amount that we're willing to pay as a maximum on that per share basis, or we could do something like a market order. We're just saying we're willing to spend whatever it takes to get into this contract. There are risks for doing that. Let's see, a couple of other questions. Real Kick Blocks says, do I need to sell the contract at the end of the time period? Great question. We actually, the trader, let's say the stock has been rocketing up. Maybe they hit that $25 target, but it only took a few days to do it. Well, actually, what they might choose to do is sell the contract at that point. With a stock up there at $375 and we have the right to buy the shares for $350, we could then basically go out and advertise it. Hey, everybody, I have a $25 discount on shares that I'm willing to sell to you. And we sell the contract to someone else for at least $25. And we paid $13.60 for that. Now I say at least $25 because there'd still be some time left for that contract to maybe get more valuable for the new owner. But yeah, we're not stuck in this thing for 45 days. We can choose to sell, assuming there's liquidity, and that's one of the reasons why we chose a heavily traded stock like Visa. We should be able to sell that. And again, you can run into liquidity issues. Anyway, let's see. Guys, I'm going to leave it with that. We've actually accomplished everything that I set out to do today. Now, you might feel like, hey, my education on options is not complete. This was a good introduction, but there's still a lot more for me to learn. Yep, I definitely have a suggestion for you there. If you are brand new to options trading, make sure, first of all, that you subscribe to our Trader Talks channel on YouTube. You just pop down below the video stream right now, click on the subscribe button. It doesn't cost anything to do that. It only takes a moment. But this is where you can watch our live streams, but you can also do keyword searches for topics of interest, or as I demonstrated a little bit earlier, you can go to our playlist page, and on that page, this is where you would find previous webcasts. There's a video series that I put together that it's a series of 10 lessons that'll just walk you through learning about options. Starting with building block number 1, long calls, and then long puts, and then short calls and short puts, and learning about the Greeks and options pricing, and then getting into fancier strategies down below. So go check that out, but also check out my ongoing series. It's called Getting Started with Options. That's what you're watching right now. So it's a separate series, but you can find that. Just scroll all the way down to the bottom. Lots of different webcast series. This one happens to be all the way down at the bottom, Getting Started with Options. Click on View Full Playlist. And each week I just sort of choose a different topic that relates to getting started with options. All right? And there's a huge quantity of archives that you can find there. Now, another suggestion that Kevin and I have for you is to follow your favorite Schwab presenters on social media. You can find us on X, you can find us on LinkedIn, but that's a place to connect with us in between the live streams. So you can find Kevin on X at Kevin Horner CS. You can find and follow me on X at Cameron May CS is my handle. That's the guy you're looking for. There's my backdrop. But if you reply to one of my frequent posts here, I just reply to you. and there it opens that channel of communication when the camera's not on. You can also do the same thing on LinkedIn. Just go to linkedin.com/in. I post here as well, and if you reply to my post there, I try to reply right back to you. Now, I also noted that there is a survey in the chat window for the live audience. So if you're here in the live audience, do me a favor, click on that survey link. The survey will pop up. You can give me some honest feedback now about how you thought the session went, but it's only 2 quick questions. And then a comments box and a suggestion box. And what I'll say is that I read through that data. I read those comments. It's never a wasted effort. But final note, thanks for all the likes. With hundreds of people watching, I can see I've already had 113 people click the thumbs up. That helps. That's appreciated. That's like a pat on the back to your presenter, but it also gives me a boost in the YouTube algorithm, helps more people find these videos. All right. Everybody, thanks for giving me your time today. I will look for you in a future webcast. I have a new one every day of the week on a range of different topics. So I'd love to see you in my other webcast series, some for trading, some for investing. But I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.